where do you stand in relation to passive and active asset management?
I think overwhelmingly the most important thing is to get your passive right, and that means diversification in terms of asset class, diversification in terms of country, diversification in terms of currency. Because I think what most people don't understand is that markets adjust so that they're all, at any point in time, almost have about the similar risk-adjusted expected returns. People don't understand that because they think, well, this company is much better than that company. Well, because the world adjusts those prices, because if it didn't adjust those prices, then life would be easy. You would just pick all of those companies that you didn't like, and you would be short those relative to the ones that you did like. And most investors don't really somehow get that. And so as a result, all of these come up and down, you know, and they readjust. So with that in mind, the ability to take geographic diversification, asset class diversification, I think is just most important. So your asset allocation mix, you know very well, your asset allocation mix will be your main thing. Then if you take out alpha, so how much active, that is alpha, it really depends on it's zero sum. So it's can you get good poker players to sit in the hand and make money and take it away from other people? And that's going to be a problem. It's going to be a problem because almost any good poker player, any good alpha manager is closed. Our Pure Alpha Fund is closed. You know, you can't invest in our Pure Alpha Fund because that's the nature of the beast. And then how much can you allocate? So alpha is a very difficult game. To produce alpha is more difficult than to win in the Olympics. Because there are more people who are trying to produce alpha. The rewards are a lot better if you can do it. We put, you know, many hundreds of millions of dollars a year into research to try to do it, to compete with others. So the most important thing is to get your strategic asset allocation mix right and to largely have it balanced, I believe.
Another question, you mentioned in terms of, in the long term, the returns for private equity is similar to public equity. So the question is really in relation to emerging market and developed market. I assume you will agree that in the long term, they are equal.
They're on a risk-adjusted basis, they're basically equal. And also, by the way, rebalancing, being diversified and rebalancing contributes to, not only reduces risk, but it also contributes to the return because you're tending to buy the thing that went down and sell the thing that was higher. Rebalancing is a good discipline in and of itself.